Imagine this: a company known for princesses, talking animals, and musicals writes a blank check for $4 billion to buy a comic book publisher. Not for nostalgia, not for amusement parks, but for characters in tights. That comic book publisher had filed for bankruptcy a decade earlier, sold many of its best characters to other studios just to survive, and had never proven sustained blockbuster success. Yet on December 31st, 2009, the Walt Disney Company completed the acquisition of Marvel Entertainment, unlocking over 5,000 characters, from Iron Man to the Guardians of the Galaxy. At the time, analysts asked, is this overpaying? Can comic characters drive billions? Can Disney transform a niche franchise into global dominance? Today, because of this deal, the Marvel Cinematic Universe has generated tens of billions at the global box office and spun off merchandise, streaming exclusives, theme park worlds, and pop culture ubiquity. So the real question isn't just why Disney bought Marvel. It's what did Disney see that everyone else missed? By 2009, Disney was a cultural giant, but it had a hidden vulnerability. Disney's brand was synonymous with family and wholesome entertainment. Princesses, musicals, animated features that dominated youth markets. But Disney underperformed where Hollywood was growing fastest: action and superhero films, male and young adult demographics, franchise universes that spanned sequels, spin-offs, and crossovers. Prior to Marvel, Disney's biggest action franchises, like Pirates of the Caribbean, were successful but episodic, lacking the interconnected universe model emerging in Hollywood. Meanwhile, Disney had already spent $7.4 billion on Pixar in 2006, arguably to strengthen its narrative engine after years of weaker animated releases. Still, Disney's film slate skewed toward family and youth markets. The studio needed depth in action genres, where Disney's presence was emerging, but far from dominant. At the same time, the industry was changing. Studios were increasingly judged by their ability to sustain franchise universes. Standalone movies were losing strategic value. Ownership of intellectual property, IP, was becoming the new currency, because IP could be monetized across films, merchandise, TV, streaming, and theme parks. Disney's leadership, including CEO Bob Iger and CFO Thomas O. Staggs, recognized this shift. They weren't just buying films, they were buying content pipelines. Disney had scale, global distribution, theme parks, satellites, vast consumer products reach. What it needed was content that could be woven into every layer of the business. At the time of the acquisition, Marvel was not the unquestioned powerhouse it appears today. A turbulent past Marvel had once been a dominant comic publisher, but by the mid-1990s had filed for bankruptcy due to collapsing comic sales and overexpansion. To survive, Marvel sold film rights to its biggest characters to other studios. For example, Sony controlled Spider-Man, Fox controlled X-Men and Fantastic Four. Licensed characters widely to generate cash, shifted to a licensing and publishing model. By late 2000s, Marvel had just begun producing films in-house. A bold move that changed everything. Early film success, proof of concept Iron Man, distributed by Paramount, was a breakout hit. The Incredible Hulk performed respectably. These films proved Marvel could build a shared cinematic universe, a concept no major studio had fully achieved at scale. In 2008, Marvel's financials showed growth, third-quarter revenue and licensing gains tied to these films. Still, Marvel's business was fragile. The company was heavily reliant on external distribution deals, financing films with debt, and lacking the global marketing infrastructure that Disney could provide. Some major characters remained tied up with other studios, a strategic bloat that Disney would later have to manage. So Marvel wasn't weak. It was potential waiting for scale. When Disney signed the deal in 2009, it wasn't impulsive. It was strategic, modeled, and highly analytical. Disney paid approximately $4.2 billion, a mix of cash and stock, representing about a 29% premium over Marvel's closing share price. What Disney bought 5,000 plus characters, an intellectual property reservoir unmatched in scale, a growing film studio already proving success, licensing deals across merchandise, video games, and TV, a passionate global fan base. Why? It made strategic sense. Disney's financial analysis went beyond current numbers. Executives conducted discounted cash flow, DCF, forecasts on future movies, merchandise, and licensing revenue. Comparables analyses against competitors like Warner Bros., DC Properties, and animation studios. Disney's internal evaluation showed that Marvel's IP had enormous future value across dozens of platforms. Big risks at play. But risks were real. Valuation risk. Disney paid a high multiple, roughly 37 times projected 2009 earnings. Sequels and fatigue risk. Audiences could grow tired of superhero films. Creative misalignment. Disney's family-friendly culture could dilute Marvel's edgier appeal. Rights complexity. Key characters were under contract with other studios, Spider-Man, X-Men, creating operational complexity. Disney's leadership mitigated these risks with smart decisions. They preserved Marvel's operational autonomy. They allowed Marvel Studios, led by Kevin Feige, to run creatively with strategic oversight. Disney didn't force Marvel into the Disney mold. They used Disney's scale to amplify what was already working. The results weren't just good. They were transformative. Box office impact. The Avengers grossed approximately $1.52 billion worldwide, smashing expectations and proving the shared universe concept. Disney's Marvel films have collectively made more than $18 billion at global box offices as of 2019, and that number has continued to rise. Post-acquisition, Disney turned Marvel into an annual tentpole release machine, a keystone franchise across theaters, TV, streaming, parks, and merchandise. 360 degrees monetization. The acquisition unlocked value in movies, reliable box office juggernauts, merchandise, action figures, clothing, collectibles, Disney Plus originals, expanding narratives with series like WandaVision and Loki, theme park attractions, Avengers, campus and integrated experiences, global licensing deals. Disney turned Marvel into a content engine, not just a film brand. Industry shift. Disney's success rewired Hollywood. Franchise universes became strategic imperatives. Studios raced to build interconnected franchises. Film distribution became inseparable from streaming distribution. Others tried to emulate. Warner Bros. Attempted a DC extended universe. Universal tried its dark universe, with mixed results. Disney's real innovation wasn't owning superheroes. It was building a narrative ecosystem that kept audiences invested across years and formats. The real reason Disney bought Marvel wasn't the characters. It wasn't just the box office. It was control of narrative momentum. Here is the strategic insight that defines this acquisition. Disney recognized the future economy runs on repeatable owned stories. Superheroes are merely the vehicle. What made this acquisition epoch-defining was intellectual property creates generational cash flow. Stories connect audiences across media. A shared universe builds network effects. Owned characters anchor loyalty, merchandising, and long-term planning. Disney didn't just solve a near-term demographic gap. They future-proofed their empire. They turned a fragmented library of comics into a global brand ecosystem, a year-round release schedule, a cross-platform narrative factory. Most companies chase hits. Disney created habits. Disney didn't buy Marvel for $4 billion. Disney bought a machine that could produce billions, not simply from box office receipts, but from the emotional investment of viewers and consumers worldwide. And that is the strategic DNA that will influence entertainment for decades to come.